The world's central banks seem to be positioning to remonetize gold. Trump, when he first took office, was let's audit Fort Knox, let's make sure the gold is there. There were all these signals that we could potentially end up on some sort of gold standard again. When we matched the very bottom and that top up, it was projecting that this bull market would be 2.6 times greater in magnitude and 3.1 times longer than the 70s bull market. But it was projecting $9,000-$10,000 an ounce gold. The reason that the gold-silver ratios averaged about 15 to 1, somewhere between 13 and 16 to 1 all over the planet was simply because if you've got a certain number of coins in circulation, you got 13 of these silver coins for each one of these gold coins in circulation, it's the free market, finding this equilibrium, the exchange rate. And right now, at 85 to 1, I think is what it's at. And during COVID, it shot up to 120. Silver has never been that cheap compared to gold.
The global financial landscape is preparing for a monetary transformation. Central banks worldwide are quietly repositioning toward gold, signaling a potential shift back to hard money after decades of fiat currency expansion. The signs are everywhere, from nations accumulating reserves to discussions around auditing historic holdings. Yet, this time, the re-monetization of gold could come amid record debt levels and a currency system stretched to its breaking point. A return to gold-backed stability would require astronomical revaluation, numbers so high they would shock the modern financial system. Still, this adjustment may be inevitable as confidence in paper money wanes and the world seeks something tangible to anchor value once again. Mike Maloney, a renowned author and educator on monetary history, has long described this process as the Great Wealth Transfer. His analysis reveals that gold and silver are not simply commodities. They are the measuring sticks of value that expose the decay of the current system. As the gold-to-silver ratio reaches extreme levels, and as debt-fueled fiat currencies lose purchasing power, the final phase of the metals bull market could deliver extraordinary gains in record time. History suggests that every monetary reset follows the same path, from excess and faith in paper to fear and a return to tangible value. Those who recognize this shift early will stand on the right side of history as the world reawakens to real money once more. Now, we present the clips from Mike Maloney's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
And the people that are selling are going to regret it one day. They really will. It is sad to see the East buying and the West selling because it's a wealth transfer that is going on. And we are nowhere near the top of the precious metals markets, and the things that tell you that are things like the Dow gold ratio, the gold-silver ratio. In 1980, when gold and silver peaked on the same day, the ratio between gold and silver took 14 ounces of silver to equal the value of 1 ounce of gold. And that is about the natural ratio is that there's about 19 times more silver in the Earth's crust than there is gold. Silver tends to occur more up toward the surface and gold is deeper. And so when we would dig it up back then, the reason that the gold-silver ratios averaged about 15 to 1, somewhere between 13 and 16 to 1 all over the planet was simply because if you've got a certain number of coins in circulation, you got 13 of these silver coins for each one of these gold coins in circulation, it's the free market, finding this equilibrium, the exchange rate. And right now, at 85 to 1, I think is what it's at. And during COVID, it shot up to 120. Silver has never been that cheap compared to gold. And I do believe that you are absolutely going to see the gold-silver ratio at 20 or less. So that means silver's value rises compared to gold. JP Morgan say prices as high as $10,000.
Yeah, exactly. Jamie Dimon.
And so this is a major shift, and it sort of signals that we're probably going into the third and final phase of the bull market, which is the greatest gains in the shortest period of time, usually. The bull markets have 3 phases, and this final phase, like I said, greatest gains in the shortest period of time. Well, what are the gains that we've had so far? We've gone from 250 to 4,500 bucks an ounce. These are some huge gains already. If you look at we created an interactive chart where we overlaid the bull market of the 70s with the bull market of today, and then there's something called Elliott wave analysis. And you take these waves, the first wave, the wave, I can't remember whether it's A, B, and C, or if it's 1, 2, and 3. But
I think it's 1, 2, 5, up to 5, right? Is it? Okay. I'm not an expert.
1, 2, 3, or 1, 2, 3, 4, 5. Yeah, it's either 3 or 5 waves. And when we matched the very bottom and that top up, it was projecting that this bull market would be 2.6 times greater in magnitude and 3.1 times longer than the 70s bull market. But it was projecting $9,000, $10,000 an ounce gold. And it's interesting to see these major banks and financial institutions, they were telling you to stay away from gold when it was 250 bucks. And now that it's $4,000, they're saying, oh, maybe you should put 20% of your part. Why? Because it's been the number one performing asset class of this century since the year 2000. The only thing that has outperformed precious metals is cryptos. But you know, if you start at zero, from 0 to 1 is an infinite return. So cryptos have done spectacular. I've been in them since 2014. I told my insiders about it and recommended that they take a position in cryptos. But as cryptos go up, I sell some and I take profits and turn it into silver. So yeah, I think that we have some spectacular times ahead of us. Now, can you imagine if Morgan Stanley is the 60-40 portfolio with 60% equities and 40% bonds. And they're saying sell half of your bonds and convert that into gold. Now, if that happens, you're talking prices way north of $10,000 an ounce. Well, I own 300 ounces of silver for every ounce of gold that I own, because I've allowed the gold-silver ratio. I don't let it dictate anything to me, but at the same time, I pay a lot of attention to numbers and I try to keep emotion out of my investment decisions. And with the gold-silver ratio at these absolutely absurd, I mean, if you look at it, for 2,500 years, it was about 15. Yeah. And suddenly here we are in just the last century where we're visiting the levels of 100. So silver is just way, way undervalued. And so I believe that for every, if it's at 80, if you buy if you buy 100 ounces of silver, you're going to be able to exchange that at 20 for 4 times more gold than you paid for, basically. The world's central banks seem to be positioning to remonetize gold. Trump, when he first took office, was let's audit Fort Knox, let's make sure the gold is there. There were all these signals that we could potentially end up on some sort of gold standard again. The problem is, with the levels of debt we have, I believe it's like $140,000 an ounce to pay off the national debt. And revaluing it to current market levels isn't going to make even a dent in the current national debt. And so it would have to be at prices far higher than that. The problem with that is it will upset the world economy so much. There's going to be some sort of giant convulsion that we go through. But in my book, The Great Gold and Silver Rush of the 21st Century, I sort of lay out we had the classical gold standard from the late 1800s until the end of World War I. And then we went on something called the gold exchange standard between the wars. And then we went on the Bretton Woods system from 1944 to 1971. And now we're on the global dollar standard. And these are vastly different monetary systems. It's not the same at all. People just don't, the common man was unaffected by these changes because they were little baby steps off of gold. So you went from something that was rock solid to a little less of that something to less to none. And so now it's just air. It's faith that the dollar is going to buy you something tomorrow because it bought you something today. And I believe that now we're going to take this huge step from nothing back to something. And that is going to affect everybody on the planet. Every person will feel it. I'm on the record for saying that gold standards suck. Gold is great. A gold standard is some sort of representation of gold. The dollar used to be redeemable in gold. So if you're talking about fully redeemable currencies, the classical gold standard, there was 100% reserve. The Treasury, for every $20 bill that was in circulation, there was a $20 gold piece in the vaults. And so you could take your currency. By the way, in my first book, that's where I started this sort of one-man war on educating people the difference between currency versus money. Aristotle was the first person to define the key attributes that something had to have to be considered money. It's got to be a medium of exchange, a unit of account, but most of all, a store of value. And the very design of national fiat currencies that are borrowed into existence, the math says that they absolutely must lose value over long periods of time. It would be sort of a reverse Gresham's law. Gresham's law says bad money chases good money out of circulation. And what would happen is people would want to be spending all of the bad money, the currency of the countries that aren't backing with gold. So they'd be going to the currency exchanges and trying to sell the unbacked currency and exchange it for a currency that is backed by gold and more trustworthy. It requires, though, a really catastrophic event where there's a lot of fear and everybody is seeking safety. And then you will get this reverse Gresham's law.
Speculative traders or financial algorithms aren't driving the latest surge in gold demand. It's being led by central banks in the East, with Asia and India absorbing record physical supply. This is a quiet but powerful signal that confidence in fiat money is eroding beneath the surface. Every major bubble, from stocks to real estate to bonds, has been inflated beyond its sustainable limits. When all three are in simultaneous excess, the outcome is not stability, but crisis. The monetary authorities continue to kick the can. Still, history suggests that the endgame of such cycles is always the same, a reset toward tangible assets that cannot be printed, inflated, or defaulted upon. As gold prices climb, the pattern of demand reveals a fundamental shift. Unlike in speculative manias, where higher prices deter buyers, gold and silver thrive as faith in the system falters. This dynamic mirrors the 1970s, when the public turned from inflated paper promises to tangible stores of value. The same sentiment is beginning to resurface today, as inflation, debt, and policy mismanagement converge into one massive reckoning. The dollar's value continues to decay, and while officials insist on stability, the math doesn't lie. The world is preparing for a financial transformation that will favor tangible assets over illusions of wealth. Let's get back to the interview.
Central banks are still buying. It definitely has not peaked. In this last run-up, it was basically Asia and and India pushing the gold price, and it was physical demand instead of all the gambling on the commodities exchange and the LBMA. And so it's telling me that we're getting closer and closer to a crisis, and it's impossible for bubbles to just go on forever. So we're at a period of time where they are trying to kick the can down the road, but with things at the extremes that they are at right now, I'm expecting something within the next year or so. I'm actually surprised that we got through October with no big event. October is always that spooky month. As the price goes up of something, usually anything, there's less demand because people they look for a less expensive alternative. Gold and silver violate that, and we just saw that with this run-up. This run-up was largely caused by physical demand in Asia, Australia. It was interesting in the United States, we weren't participating yet. In fact, there was a lot more sales than buys, and refiners in the United States got all clogged up. Well, this is exactly what happened back in 1979. Silver lagged for the bull market of the 70s, and then just suddenly, when gold started becoming perceived as too expensive, and today, $400 doesn't sound too expensive. But you got to remember, before 1980, the average income in 79 was like $9,600 a year in the United States. And so gold had gone from $35 in less than 8 years, $35 to $400. And so the average guy, if he's in his 40s, $500 may have been the majority of his savings. I don't know. But he goes into the bank, takes out $500, rushes to a coin shop and says, I want to buy gold too, and they drop $1 coin in his hand. And at that point he goes, oh, is that all I can get? How much is the silver? And it's when the public changes their preference from gold to silver that, people blame the $50 silver price in 1980 on the Hunt brothers. And it's absolutely not true. They added 50 to 75 cents at the most to that market. It was really the public changing their buying preference, silver being perceived as a better bargain. The state of the economy is, I hate to say it, we're screwed. That's what you look at what every president has done, and they run on a platform. They're going to reduce the budget deficit, they're going to balance things, and then as soon as they get into office, they go exactly the opposite direction. Because the population likes it when you're handing out free candy. And that's basically what they're doing, is they're keeping the population appeased at the expense of the, I hate to say it, but I do think that we are headed into a huge global financial crisis. In 1929, the stock markets were in a bubble. In 1966, stocks were in a bubble, and they worked their way off. The Dow bumped its head on 1,000 points in 1966 and couldn't break out until 1982. So stocks went sideways during a period of raging inflation. And so corporate profits and stuff went up during that period of time. And so all of the PE ratios and the indicators that tell you whether stocks are in a bubble or not worked themselves off. So we had a correction without a crash. But the first time it was stocks moving, gold was fixed, and real estate was not in a bubble in 1966 to 82. And then we had the NASDAQ, the tech bubble of 1999-2000. Again, stocks in a bubble, but not real estate. Then it was both from 1971 to when gold became free trading. It was only gold moving that caused this correction in the gold to the Dow gold ratio, the stock market to gold. It was only gold moving. This time it's both. Gold and the markets are moving. We've got, in 2008, the global financial crisis, stocks had already been beaten down from the 1999-2000 tech bubble popping. And so stocks were just above, the stock market was above fair value. It never was allowed, Ben Bernanke papered over all the cracks, and it was never allowed to go to undervalued so that we built a solid base again. What they did was they just, as everybody knows, created tons of currency. They exceeded my wildest nightmares because I had written all about this and about his response to the next crisis in my book that came out just months before it all happened. But this time, stocks are in a bubble, bonds are in a bubble, and real estate is in a bubble. And these are bubbles of historic proportions. The only way that you can measure the stock market that shows it not in the greatest bubble in history is PE ratio. All of the other measures, the Buffett indicator and the different ways of measuring it, all show it in the greatest bubble in history. Real estate, same thing. And then bonds, we had a bull market in bonds from 1980 until just the past couple of years. So bonds are also in a bubble.
40-year bull market in bonds, right?
Exactly. And so you can't have something go into a bubble where it's out of whack with the rest of the economy. Permanent. It can't stay there permanently. Something has to happen. Either the economy has to grow to match it, and that's not very likely, or there has to be a crash, a correction. And so we're going into this next big crisis with $38 trillion worth of debt, and with the Fed's balance sheet already expanded so much. In a 2015 update to my first book, I wrote that the next time that they do QE, they're starting it from a base that is already so high. There was $800 billion in the bank reserves and in base currency. Base currency is the cash in your wallet plus bank reserves. And it peaked at $9 trillion. And so we're off the rails. Yeah. But the US dollar investor can also buy gold.
Yeah.
That's the same thing as exchanging. You're exchanging your currency for money.
Yeah.
I find it interesting that you can take these pieces of paper with numbers and pictures of dead guys on them, and you can actually buy something real with it. If you take a look at all of these national fiat currencies, it's a piece of paper that's been ruined. You can't even use it to write a list on it because it's got all this ink on it already with just digits. And most only about 1 out of every $10 that exist is created by the Federal Reserve. The other 9 are created by the banks. All of them, with the exception of the currency in circulation, the dollars that are in your wallet, are just typed into existence. They don't even bother to print them. So when they say they're printing currency, no, they're typing currency. So you've got to ask yourself, how many numbers are there? Because that's the limit to what they can print. How many numbers are there? It's infinite. And so, right. And so what is the value of the dollar is the inverse of that. And if the dollar used to be worth 1/20th of an ounce of gold, and now it's worth less than 1/4000th of an ounce of gold. And so it's already lost more than 99% of its value since the Federal Reserve became the custodian of the dollar's value.
The signs are clear. The global economy is approaching a breaking point where debt, inflation, and distorted markets can no longer coexist without consequence. Every financial indicator that once hinted at stability is now flashing red. From central banks quietly hoarding gold to nations shifting away from the dollar, the groundwork for a new monetary reality is already being laid. What most investors still see as volatility may, in truth, be the first tremors of systemic change. When bubbles in stocks, bonds, and real estate begin to unwind together, history shows that tangible assets rise to the forefront. Gold and silver aren't just commodities, they're the anchors of value that expose the fragility of paper promises. The transition won't be gentle, but it will reward those who understood before the rest of the world caught on. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.